Hello all. We are an analyst group with Birkenred Reports covering Evolution Petroleum Corporation. My name is Aaron Mandel and my co-analysts are Avery Golombek, Jonathan Afra, and Lambert Daudet. We arrived at our target price of $10 by using the PV10 valuation method. This results in an investment rating of market perform, as our target price results in a 9% return over the next 12 months from Evolution Petroleum's current price of about $9. In our presentation, we will go through a description of the company, an explanation of our valuation methods, a review of Evolution Petroleum's top management, an analysis of the oil and natural gas industry followed by an analysis of Evolution Petroleum against its peers, a summary of the risks involved with the oil and natural gas industry, and finally, our personal investment thesis for the company. Evolution Petroleum was initially founded in 2003 under the name Natural Gas Systems Incorporated. The company went through a reverse merger in 2004 with Reality Interactive, but Reality ceased operations and Natural Gas Systems absorbed its assets and technology patents. In 2006, Natural Gas Systems renamed itself to Evolution Petroleum to better reflect its business operations, which included natural gas, oil, and an emphasis on technological innovation. The company's headquarters is in Houston, Texas, and is considered an upstream exploration and production company with an emphasis on production. Evolution Petroleum uses tertiary recovery to recover its reserves, utilizing advanced extraction technology instead of vertical or horizontal wells. The Delhi field is Evolution Petroleum's main source of revenues. Located in northeast Louisiana, the field was acquired in 2003 at a large discount due to minimal oil and gas recovery from primary and secondary methods. Since the sale and input of tertiary recovery methods, the field has seen a large increase in production that is projected to increase yearly until 2020. In 2006, Evolution Petroleum sold the mineral rights of the Delhi field to Denbury Resources while retaining a 7.4% royalty interest. The contract contains a unique reversionary working interest that greatly benefits Evolution Petroleum. After Denbury Resources realized $200 million in net revenue from the Delhi field, which transpired on November 6, 2014, Evolution Petroleum began to receive 23.9% of revenues and costs associated with operations from the Delhi field. This raises Evolution Petroleum's net revenue by 91% after accounting for the increased costs, which raises Evolution Petroleum's aggregate interest in the Delhi field to 26.5%. Evolution Petroleum's main technological competitive advantage is gas-assisted rod pump technology, or GARP tech for short. The technology, a type of tertiary recovery, pushes carbon dioxide into a well, increasing the pressure of the underground cavity and allowing for otherwise dormant oil and natural gas to rise to the surface. This technology is used not only in wells owned by Evolution Petroleum, but is also being marketed to other upstream E&P companies with a leasing contractual relationship for the tech. In addition, one of the fairly unique features of Evolution Petroleum is the lack of major debt on its balance sheet. Evolution Petroleum maintains a very conservative and risk-averse financial structure by keeping debt at or as close as possible to zero. This financial structure provides the company with safety during economic downturn and allows the company to remain flexible when making business decisions. Evolution Petroleum's ratios are as follows. It has an earnings per share of 8 cents per share, a price-to-earnings ratio of 1.44, and boasts a 4.38% dividend yield. The company, as of November 18th, has a market cap of $299 million and an enterprise value of $274 million. Evolution Petroleum currently has proved reserves of 13,289,000 barrels of oil equivalent. The proved reserves ratio is 79% oil and 21% gas, with 80% of the natural gas reserves being contained as natural gas liquids. We used a 7-year PV10 valuation method to arrive at our rating of market perform for Evolution. Our PV10 model uses two sources to determine the projection of prices and productions. The Birkenred price deck was used to determine the future prices of oil, and production estimates are calculated based upon information supplied by Evolution concerning their production. After calculating cash flows, we discounted by 10% and arrived at our target price of $10. Evolution Petroleum's management comes with an average of 25 years' experience in the industry. Robert Herlin, in addition to being chairman of the board and CEO, co-founded NGS in 2003 and has over 30 years of experience in the industry. Randall Keyes has only been at Evolution Petroleum for a year, but has over 30 years of financial leadership in the upstream and oil field services. David Mazzanti joined APM in 2005, but has over 30 years of engineering experience and was formerly a manager for business development for Anadarko Corporation. David Joe also joined EPM in 2005 and has over 27 years of energy accounting experience. There are two main factors for the success of a company within the oil and natural gas industry. The first are the prices of oil and natural gas. The revenues of any firm within this industry are tied to the fluctuation in prices of oil and natural gas, which are dependent on a variety of factors. In addition, secondly, the impact of governmental regulations on both from countries and international governing bodies can have a potential impact on the operations of a firm in the oil and natural gas industry. The industry from a macro perspective cannot be understood without understanding the impact of OPEC. OPEC, or the Organization of Petroleum Exporting Countries, has long had a grip on the supply of crude oil to the global economy. However, recent discoveries of mass quantities of natural gas in other countries, namely the United States, have diminished the influence of OPEC. In addition, the amount of oil supply and demand within the globe has an effect on prices and production. Oil price volatility can occur for a number of reasons. Weather is one such reason, producing a cyclical relationship with prices, as the demand for oil and gas goes up in the winter to accommodate colder temperatures. Also, the recent surge in supply of natural gas, especially in the United States, has recently caused a dip in oil and gas prices. Competition in the upstream and E&P market revolves around access to capital and the high demand for mineral interests. Evolution Petroleum is a relatively medium-sized company with regards to market cap and does not have any new immediate prospects for purchase of mineral interests. This could be subject to change in the future. We based our peer analysis on similar business operations, comparable market cap, geographic location, and position within the industry as in upstream E&P companies. We therefore chose Approach Resources, Denbury Resources, Royale Energy, Saratoga Resources, and Yuma Energy as our peers. Our metrics for comparison are market cap, price to earnings ratio, price to book value ratio, enterprise value to EBITDA ratio, debt to equity ratio, return on equity, dividend yield, and proved reserves in thousands of barrels of oil equivalent. As shown by this table, Evolution Petroleum has a market cap well below the average of its peers and also has a price to earnings ratio of almost double the average of its peers, which spells the confidence of investors in this company. However, its price to book value ratio is well below the peer average. In addition, both Evolution Petroleum and Unit Energy are the only firms among these peers to have no debt, while Evolution has 26 times more reserves than Yuma and also boasts the highest dividend yield of its peers at 4.38%. Evolution faces operational, financial, and regulatory risks, which are common among companies in the oil and natural gas industry. Evolution's team is comprised of only 9 highly skilled employees who contribute to the daily function of the corporation. They are responsible for facilitating deals, guiding operations, and obtaining capital for the company. This poses a risk, as the company could face major operational consequences from the loss of any of these key personnel. Additionally, Evolution's deli field is its most significant asset and accounts for 90% of the overall firm production. Any unexpected issues within the field could impact the firm significantly. An example of such is the June 2013 environmental event, where a well began to leak into the surrounding area. Similarly, Evolution's current litigation with Denbury regarding that event could hinder future production and disrupt Evolution Petroleum's steady revenue stream. Another significant risk to Evolution is GARP. Gas-assisted rod pump could potentially offer extended life for many horizontal and vertical wells, and the company is attempting to commercialize the technology. However, GARP has yet to be recognized as an industry-wide form of tertiary recovery due to minimal trial runs and uncertain results. Evolution fares well in terms of financial risks because of its zero-debt capital structure. The company's leverage and liquidity ratios are much higher than its peers because it is unlevered. Lastly, the political environment concerning oil and gas extraction and production is heavily regulated. Various federal and state governments regulate Evolution's business operations for environmental, financial, and operational reasons. Changes in legislation could increase operating costs, negatively impacting Evolution at any time. Additionally, the EPA, or Evolution Protection Agency, requires E&P companies to monitor and report annual greenhouse emissions. As such, stricter regulations and production limits could force Evolution to change its production process. Finally, our investment thesis. Our understanding of Evolution Petroleum and its position within the industry can be boiled down to 4 points. Firstly, Evolution Petroleum and its success is completely dependent upon the price of oil and natural gas. There's been a recent dip in those prices, which will decrease revenues in the short term. Also, there will be expanding recovery and production of natural gas in the U.S. with the recent discovery of massive gas reserves, such as the re-estimation of the Marcellus Shale to have over 250 times the amount of reserves initially estimated. The prices of oil and natural gas into the future are unknown, but will most likely increase alongside a growing global economy. However, regardless of oil and gas prices, the Delhi field is expected to continue experiencing growing recovery and production through 2020 before it begins diminishing its production. This is a promising measurement for the future of Evolution Petroleum. In addition, Denbury Resources has reached the $200 million net revenue mark, which paves the way for Evolution Petroleum to see an almost 400% increase in its yearly revenues from oil and gas from the Delhi field. Gas-assisted rod pump is a promising technology with very substantial economic possibilities, but it doesn't come without its risks. The technology may or may not see substantial usage within the industry, but it has proven to have relatively decent success so far. Evolution Petroleum doesn't have an exact way that it plans on selling the product, so this aspect of the future of the company remains an unknown with very high potential. Lastly, the fact that the company maintains such a risk-averse financial structure is an excellent feature of the company that protects Evolution Petroleum in times of hardship and enhances their ability to expand their operations in the future. We'd like to thank you for listening to our analysis of Evolution Petroleum.